Why is it so darn difficult for active investors to outperform a basic index fund? Let's talk about that, then I'll let you in on a little secret as to why I'm kind of happy that people are out there trying to continue to outperform index funds. Actively managed funds outperform the market. There, I said it because that is a 100% factual statement. Don't believe me? So far this year, roughly 70% of actively managed funds have outperformed a simple S&P 500 index fund. But it's not the whole story, and if I was trying to take your money through investing in my fund, then I could make that claim with no issues. First, we need to understand why these actively managed funds even exist if it's so difficult to beat a dumb, boring index fund. The simple answer is money. They make lots and lots of cold hard cash from investors like you. Look, the investment world is extremely competitive. They have to be with a ton of money already flowing into index funds to the tune of $11 trillion. At this point, these non-index funds are playing for the leftover scraps. Think about it, even if they convince a fraction of a percent of you to invest in their more expensive actively managed funds, they'll become rich and leave you holding the bag. I'll show you how they're leaving you holding the bag in a minute, so hang tight. Just for funsies, let's calculate how much an actively managed fund would make by stealing a small amount of money from the $11 trillion that are currently invested into index funds. Let's say the assets under management for this actively managed fund is $7 billion, and they charge an expense fee of 0.75% per year. I know $7 billion sounds like a lot, and it is, but it's only 0.063% of the $11 trillion that are currently invested into index funds. The actively managed funds would make around, wait for it, $52 million per year for that 0.75% expense that they charge. Imagine this scenario spread among hundreds and hundreds of other actively managed funds. Trust me, they'll come up with a random actively managed fund for just about anything to make a buck. So you see, these actively managed funds don't need to compete with index funds. They just need to be able to spin the narrative in a way to get you to put at least a little bit of your money into their fund over the index funds. And it seems to be working because the comment section of all of my videos are flooded with people telling me about these rando actively managed funds that they invest in. Now let me be clear, if an actively managed fund actually brings enough value to the investor to warrant that price that they're charging, then I have zero issue with it. I also like fair and open markets where ideas have the opportunity to compete to see which one is the best. The problem is that most of them don't bring that value. Let me explain. Everything comes down to the value that you receive for each dollar that you spend. If I buy $1,000 worth of an actively managed fund and they charge me $7.50 per year, then they better be bringing me enough value to offset that cost, because I could be investing that $1,000 into a simple index ETF where I pay 30 cents per year and get average market returns. It is 100% possible for an actively managed fund to beat a simple index fund. It's also possible for you to win the lottery. But what they both have in common is that neither of them are very probable. At least with the lottery, you're betting a little bit of money for enormous potential returns. With an actively managed fund, you're betting a lot of money for the potential of a very small outsized return. The odds are so stacked against investors from the very start, but the actively managed funds will leave that part out of their marketing materials, so you'll have no idea. So stacked against you to the point where 96% of actively managed large cap funds underperform a basic index fund. Yep, that means that only 4% of them ended up ahead over 20 years. It gets much worse for actively managed funds the further we go out in time. Now you might be thinking to yourself,
but Jarrad, I'm only investing 5% of my portfolio into an actively managed fund just in case it outperforms.
Did you miss first grade math class? Because that doesn't change the odds and pretty much guarantees that that part of your portfolio is going to underperform. So keep telling yourself whatever story you want, but that doesn't change the fact that the tooth fairy isn't real and Jeffrey Epstein killed himself. You know how the lottery is basically a tax on poor people? Well, I consider actively managed funds a tax on uneducated people. Oh, and I forgot to mention that after 20 years, 75% of those large cap actively managed funds either completely shut down or merged with other funds because their performance was so horrible that they couldn't even show their faces at Thanksgiving dinner any longer.
Hey, Ma! Can we get some meatloaf?
This isn't even a special case with actively managed large cap funds though. Here's a list of the rest of the fund categories and how much actively managed funds underperformed over 20 years. This is how bad it is. The best asset class to gamble on would be an actively managed mid-cap value fund, and only 22% of them actually performed better than the underlying index. 22%. Who in the world is handing out medals for a 22% success rate? I'll tell you, nobody. Well, in today's woke culture, they're probably handing out trophies to just about everybody. All of this info is from the yearly scorecard S&P Dow Jones publishes. The results end up the exact same every single year. The financial advisor who has you in a bunch of actively managed funds has a ton of explaining to do if you show this to him or her. If you like dogs and you want to help support my dog Molly, please make sure to hit that thumbs up button and also leave a comment down below with the best thing that's happened in your life over the past week. We need to talk about something that just doesn't add up with this whole thing. You've got to imagine that most of the people running these funds truly believe and act in a way that'll help them gain an edge over a basic index fund. So why can't more of these actively managed funds outperform? One of the reasons is because picking stocks that'll outperform a basic index fund is extremely difficult, no matter how smart you are or how much data you have at your fingertips. To illustrate this, let's look at some research done by the money managers Blackstar funds. They pulled the data for total lifetime returns of individual stocks from 1983 to 2006, and what they found was mind-blowing. The index they compared the individual stocks to is the Russell 3000. Now, this is a market cap weighted index that tracks the performance of the largest 3,000 US stocks. Think of it as a total US stock index fund, kind of like the one that I talk about a lot on this channel, which is VTI. 39% of stocks had a negative total return, which means that 61% of stocks had a positive return. On the surface, this seems like a good thing for actively managed funds because they're buying up individual stocks, so the odds of getting a positive return are definitely on their side. Not so fast. Just because the 61% of stocks had a positive return doesn't mean the return was good enough to outperform the index. The point of and why you're supposed to be paying a high fee to these active funds is to outperform. Because if they don't, then why in the world would you continue putting your money into these funds instead of a basic index fund? If we dig a little deeper into their findings, we see that 64% of stocks underperform the Russell 3000 index. This means that the actively managed funds you invested in would have had to have invested more money into the 36% of stocks that outperform, because just investing money into the winning stocks would not be enough. The amount of dollars in those winners would have to offset the losses they incur from the money they surely invested into the stocks within the 64% that underperform. But wait, it gets even more difficult for active investors to outperform. Only 25% of stocks were responsible for all of the market gains, which means that a very small number of stocks account for the majority of the stock market gains. So if an active investor was somehow unlucky enough to miss those 25% most profitable stocks and instead invested in the other 75%, their total gain would have been, wait for it, 0%.
And it's gone.
Picking those 25% more profitable stocks are somewhat in the control of an active investor. While not very easy or very probable, it is within their control. What's very rarely talked about are the things outside of their control, like timing. Timing is a funny one because to be successful at it, you have to be in the right place at the right time, taking the precise action needed to make the most of it. For instance, one of the most well-known successful active investors, Peter Lynch, ran the famous Fidelity Magellan Fund. From 1977 to 1990, he returned an average 29% per year to investors. This is absolutely insane by anyone's standards. But remember, timing is everything. The fund wasn't even open to the public to invest in until 1981. 4 years later, from 1981 through 1990 when Lynch left the fund, it only returned an average of 22.5% per year compared to the 16.5% for the S&P 500. Don't get me wrong, that's still a pretty darn healthy outperformance, so I'm not knocking it at all. But once again, timing is everything. If Peter Lynch would have used his same successful investing style for the previous 13 years before he started managing the Magellan Fund, then his returns would have only been around 6% per year. So you see, an active investor can have a really, really good strategy to help them outperform an index fund. But if they're too late, too early or aren't implementing this strategy during the perfect time period, then it doesn't matter. This is why we have thousands and thousands of active fund managers and actively managed funds that no one remembers. We only know about the very few most successful outliers like Peter Lynch, Warren Buffett, and Jim Simons. And the people who are unimaginably good, like Jim Simons, keeps their investing strategies top secret. He hasn't achieved average annual returns of 39% since 1988 by telling the world how he invests or starting an actively managed fund. If he did that, then people would try to replicate or front-run his strategy, which would destroy his returns. Let's ignore the 22.5% returns for a second though, because that was dependent on Peter Lynch and Peter Lynch only. There are two other elements of timing that plays a role in what kind of returns you as an investor receive from these actively managed funds. Firstly, to receive the full returns, like 22.5% from the Magellan Fund, you would have had to have been invested from the very beginning. Most probably weren't and jumped on board of the actively managed fund after it had started performing very well because humans are insanely irrational. This is a mistake a ton of investors made on a regular basis back then and continue to make today. It's also why I constantly tell people not to choose funds based on past performance because those numbers are irrelevant to someone getting in the fund today. No one, of course, will listen to me, but I'll continue to shout that out into space, hoping at least one of you aliens hear me. Secondly, even though the Magellan Fund got a return of 29% per year, Peter Lynch openly admitted that the average investor only made around 7% per year during the same time period. How in the heck could that happen? Simple answer. Humans chase past performance, then run for the doors when it doesn't continue to perform the same way. We see it all the time. Money flows into the fund, then flows out of the fund because investors are irrational. As many of you may not know, more money flowing into an actively managed fund can be extremely problematic. When an active fund manager performs very well, we start to see a lot more money coming in for them to invest due to their recent success. You'd think this was a good thing because more assets under management means more money for them to deploy into their successful investment strategy. Bigger is not always better, and this is definitely the case with actively managed funds. In fact, it can eventually be the downfall of a very successful fund. This is due to something called asset bloat. If more money comes into their fund to be invested, the manager has to find stocks to invest in with that new money. If he or she starts adding more money to the same types of stocks, then that might overweight them in certain stocks or sectors that would expose them to different risk factors that they're trying to avoid. Because of that, the fund manager might have to start putting new money into different sectors or stocks that don't 100% align with the fund's investment strategy, which in turn will reduce the overall returns. Now, a fund can avoid this issue by closing itself off to new investors, but most of them don't because they're greedy. More assets under management means more money that they receive in fees. Ego infects every single one of us, and when money is on the line, active fund managers are just as much, if not more prone to playing to their ego as well. As professionals, when they have a little bit of success, they might chalk their success up to skill when in reality, they just got lucky. In the short term, luck looks like skill. But over the long term, we find out who was truly lucky and who was truly skillful. MIT even found that the success of mutual funds was due more to luck than it was skill. Fama and French also came to the same conclusion. Successful investing has more to do with luck than skill. Even though that information is wildly known, ego will always be there to drive active investors to try to beat the market. As a 100% index fund investor myself, I'm actually pretty happy that actively managed funds are out there and people are continuing to invest in them. The truth is that if everyone invested in an index fund and nothing else, there'd be problems since everyone would continue to pile into the same stocks at the same rate. Actively managed funds are needed for stock price discovery, which is achieved when they're out there trading in and out of things and constantly adjusting prices. Please hit that thumbs up button to help support the channel. In the description of this video, there are other ways to help support what I do here as well. Watch these videos to your left next to become a better investor. I'll see you in the next one, friends. Done.